As we enter 22, the yield on 10-year Treasuries was 1.73%, also known as T-bills. That rate reached 3.4% last week, surpassing 4% in October of last year. During the pandemic's loosening, the Fed Treasury returns were in single digits. In mid-2020, you could agree to tie up your money for 10 years and receive 0.52%. If you wanted to return some cash and you were risk averse, you could buy a pile of these and have no risk on that investment. Now, if you plan to redeem the bonds in 2030, no problem. You'd receive your principal plus the return. For instance, if you invested $100,000 this way, you could expect your investment to yield $520 per year for the duration. But what if you needed your principal before the maturity date of 2030? You could sell the bonds on the market, but at a steep discount. Using the current yield of 3.4%, your principal would be worth $15,294, close to an 85% loss in shortly 3 years. This oversimplified example is part of what caused Silicon Valley Bank to fail and is being seized by federal regulators. When a run on deposits occurred last week, the bank was forced to take a loss on its bond portfolio and to cash out to its investors. Bonds moved inversely. As the price of bonds increase, its yield decreases, and vice versa. Cap rates on real estate behave similarly. As cap rates increase, the value of the underlying property decreases. To the question above, what impact a bank failure might have on commercial real estate, and here's the answer. The Federal Reserve may not raise interest rates as aggressively as planned. When the Fed Reserve began its march towards a federal funds rate target of 6%, with a series of 0.75% hikes, ensued an effort to lower inflation to the 2% goal they had out there. These 0.75 increases turned into 0.25 increases earlier this year, as inflation has shown signs of easing. Now, what we experienced a couple of months for strong numbers compared with increased wages and a resilient consumer who refuses to stop spending. Many believed a 0.5% increase was in the works for March. However, because of the rapid increase in the Fed funds rate, some believe we could avoid an increase altogether. Wasn't the case. It went up 0.25. All the same, borrowing costs may increase. If depositors believe certain banks are riskier than others, they'll demand a greater return on their money for the added risk, resulting in higher depository costs. If failures cause a revamp of banking regulations, similar to what we experienced in 2008, reserve requirements might increase. The impact of these two factors means fewer, more expensive dollars for lending. Investor activity may slow, and we saw a dramatic decline in institutional investor activity in the second half of 22, with only private capital investors remaining. Historically, this investor genre will pay less than institutions, and mainly because they borrow money to effect the buy. A classic disconnect is now occurring between buyers and sellers. Unless there is distress on behalf of a seller and or tax motivation on behalf of buyers, the dance ends before the band tunes up. I don't see this ending anytime soon. Cap rates may get even higher. Expect higher cap rates because all of the above, keep in mind. Also, a year ago, 3.75 to 4.25 cap rates were the norm. Traditionally reserved for bondable absolute net investments like Amazon on a 10-year lease with 4% annual rent hikes. Capital, seeking return, poured in anything with a truck door. Many eschewed long-term leases in favor of shorter terms, where a rent pop could sooner be realized. Now the government will pay you 4.2% for a 2-year Treasury backed by the full faith and credit of the United States. Sure, you don't get the appreciation or depreciation of real property investment, but there's no risk in it 4.2%. Something to consider. Money is better spent elsewhere, is my opinion. But if you're in need of an experienced commercial real estate broker, I can be reached at 281-222-0433. Thanks for your time and have a good day.